A quick question: would you rather receive $100 today or the same amount exactly 1 year from now? Almost everyone would choose today. That instinct is actually the foundation of modern finance. Mortgages, investment, pension, stock market, billion-dollar business deal, all of them are built around this one idea: the time value of money. At its core, the concept is simple. Money today is worth more than the same amount in the future because money today can grow. If you receive $100 right now, you can invest it, save it, or use it to generate return. But if you have waited a year, you would have lost an entire year of opportunity. This is opportunity cost, and it is what shapes almost every financial decision we make in the world.
Let's move on to why future money shrank. Growth isn't the only reason future money loses value. Future money also faces risk. First, their inflation. Over time, price rise. The same $100 that fill a grocery cart today might buy noticeably less a few years from now. Then, their uncertainty. What if the company promising the money struggle financially? What if the economy change? What if the market become unstable? The further into a future payment is, the more uncertainties around it. Because of that, people expect compensation for waiting and taking on the risk. In finance, that expect return is called the discount rate, and it's set at the center how investments are valued. The higher the risk, the less future money is worth today. And that's why finance is never just about dollar. It's about time, risk, and uncertainty all working together.
So now let's move on to compounding and discounting. A useful way to picture this is to imagine time as a straight timeline. Compounding pushes money forward through time. For example, if you invest your money today, it earns returns. And then those returns start earning another return too. So over the long period, that growth can become surprisingly increasing and powerful. And this is the reason why people always talk about starting early when it comes to investing. Time does a huge amount of the work for you. But if you look at the discounting, it works in the opposite direction. Instead of asking what will this money grow into, it would ask what is the future money actually worth today. So for example, imagine someone promised you to give $100 5 years from now. It sounds like a really good thing at first. But once you factor in inflation, risk, loss in investment opportunity, and that future of $100 may only be worth around 62 in today's term. Which means that the further away the payment is, the less valuable it becomes right now because it accounts for many factors like I described.
How businesses use this every day. This isn't just theory. It shapes real decisions every single day. Where a company decides to build a new factory, launch a product, or buy out competitor, they are not just looking at future profits on paper. They use discounting to ask one question: how much are those future cash flows actually worth today? A project might sound exciting, but if the risk is too high, or the returns take too long, it might not be worth it at all. Risk also changes over time. A new company feels very risky at first, but as it grows, gains customers, and stabilizes, the uncertainty drops. And when the risk falls, future cash flows become more valuable. That's why finance isn't just about spreadsheets. It's deeply connected to human behavior, confidence, and expectation about the future.
When we talk about the finance, these ideas are not just for large corporations or investors. They are additionally applicable to everyday things such as mortgage, retirement plan, pension, rental income, and long-term investment. In finance, one important question is how much is future money value today? Because $1 million promised 30 years from now is very different from $1 million you already have today. Why? Because time change value. At the end of the day, almost every major financial decision comes back to one simple truth. Money have a time value. Compounding have money to expand over time. Discounting reveal what future money is actually value now. And once you understand this idea, you start seeing financial decisions differently. A flashy future payout unexpectedly become less attractive. A loan become easier to evaluate. And investing start making a lot of more sense. Because in finance, time is not just important, time is money.